Welcome to Inside Exchange, Topics for Manufacturers, a series bringing you expert-led presentations on the issues that matter most to members. The curated topics in this series feature presentations from associate members and subject matter experts through on-demand and live webinars to help Hudson Valley manufacturers. If you have topics you'd like us to explore in future episodes, contact us at info@councilofindustry.org. Let's begin.
Hello, everyone, and welcome to this edition of Inside Exchange, our on-demand video series designed to bring manufacturers timely and relevant insights from industry experts. Today's episode is focused on energy markets and what manufacturers should be thinking about as we head into the summer of 2025. Whether you're managing a single facility or a multi-site operation, understanding the energy trends and pricing strategies is critical to managing risk and planning ahead. Since 2004, the Council of Industry has supported our members in navigating complex and often volatile retail energy markets through our Energy Buying Consortium. This program leverages the collective buying power of our members to access competitive rates, reduce volatility, and make informed decisions. We've partnered with NRG, our preferred energy supplier, because of their financial strength, deep industry knowledge, and commitment to supporting manufacturers in the Hudson Valley. Joining us today is Dylan Haas, account executive with NRG. Dylan has worked closely with many of our members over the past year and brings valuable insight into the forces that are shaping energy costs, supply, and risks in the months ahead. We are grateful to have Dylan as a part of our Inside Exchange series and as a resource for the Council of Industry. Dylan, thank you so much for agreeing to do this. Let's get started.
Thank you very much. Very happy to be here. Happy to share some more information to help make sure that you and your companies feel equipped and educated in this very volatile, exciting energy market that's always changing. I do have some slides I'd like to share today. I do need, for legal purposes, to share the safe harbor acknowledgement. This is just demonstrating the fact that we will be providing a bunch of informational and educational-based information for your consumption and for your own knowledge. But decisions you make for hedging will be yours and yours alone. We are here to help in the strategy creation process, but we do want to acknowledge that these are ultimately your decisions. In fact, when we do look at why we say these things, it's because these are very volatile markets. So the first thing, I just want to kind of paint an overview for what we're dealing with, because when we look at these markets for natural gas and both power, we have a lot of variances in what's been going, whether it be from a weather system that's been changing over the last year compared to where we were for the last 3, to how headlines have been, to different capacity items in the markets, or even just how we manage your types of accounts, depending on your organization and your risk preferences. There's a lot of different products out there that you could be working with. So we are here as your partner, NRG, through the Council of Industry Buying Consortium, in order to help you feel like you are prepared to take on these ever-changing natural gas and power markets. So I want to talk, just generally speaking, first about how these fundamentals lie. And I thought this is a really strong introduction, just talking about the different things we're always paying attention to. So if I'm looking at these markets, what are the primary fundamental factors that I'm referencing throughout today's slide deck? And then anytime I'm in conversation looking at your types of contracts as well. Well, these are the fundamentals listed out. And although it does kind of look like we're weighting certain ones more than others, for example, we're saying it almost looks like weather doesn't matter as much as financial markets in this situation, but that's not always the case. And in fact, these can flip-flop any which day. They're interdependent. They are dependent on one another, and they can very much and very quickly fluctuate in importance into the pricing of your contracts and how you ought to be considering how you'd like to manage money on a day-to-day and even minute-by-minute basis. So when we look at the complexity that drives these markets between all these key fundamentals, we want to make sure that you guys feel equipped to be able to be ready to make educated decisions. Each one of these factors we are monitoring daily and are here to help you if you have any questions. And today we're going to talk about a few of them. And actually, weather is going to be the first one, because as of late, we did just receive our summer forecast. But before we get there, we need to talk about how we got into the weather system we're seeing today. And as of late, we're sitting in we are sitting in what we call a shoulder season in the energy markets here. And a shoulder season just means it's not summer, it's not winter, not high usage for either season. So when we look at what was most recent for high demand seasons, which was winter of 24-25, there is something we do want to note, and that is that there was a large deviation, especially in the January timeframe, that led us to having very cold temperatures across the United States, which was a deviation from the forecast. And that overall change, although did still keep us from being the 26th warmest since recorded history when we started counting in 1950, it did still cause a large shift in the overall way the market's functioning because it wasn't planned on being that cold prior to the winter timeframe. This set us up so that, hey, we were expecting it to be warmer. Still was pretty warm, generally speaking, but put us in a more dangerous situation where this year we're seeing a bit more concern because we used up a lot of our storage numbers, otherwise would help bolster against potential volatility that otherwise can be hitting us in the future. So when I look at last winter, the thing I'm saying out, and I'm trying to point out what I would take away if I wasn't super involved in this, is it was warm, but it was colder than expected. And that difference from expectation and reality is where markets move. Keep that in mind as we look at this upcoming summer. This summer, we're also expecting it to be warm. But the largest concern is the fact that we sit in what we call a neutral ENSO phase. It's weather terminology, basically signifying that it could kind of go either which way for if it's going to be colder or hotter than normal, meaning there's less certainty about what's to come. What we do know is that if there is going to be volatility, it's going to happen this upcoming month, leading us to be in a little bit more of a precarious position leading into the summer. This is going to be potentially more impactful for your power for this upcoming summer if you're not in a contract right now, or if you're in a floating type contract. And then what we're also worried about for right now is that when we think about power, within the New York region especially, about 50 to 80% of your power is generated using natural gas. So if it gets really hot, we're using more electricity to power your AC units, which means we're using more natural gas to create electricity for those AC units. This means that those those dependent variables and key fundamentals kind of pile onto each other, putting us in a potentially more concerning spot for this upcoming summer and therefore upcoming winter, since that is still too far to be able to gauge whether it's going to be too cold. As a result, we've seen a lot of contracts shift upwards from where they had been last year or 2 years ago, closer, well, I guess mostly just last year after we got over 2 very warm winters in a row. But what I see when I look at this is basically saying, hey, be careful of what volatility can happen this summer. If you're not prepared yet, we should be having the conversation. Please reach out because we need to make sure that you guys are prepared for not just this summer, but this upcoming winter as well. And if we wait too long, this could be the sort of event that pushes just the little bit of contract over the edge to no longer being flat and potentially more of a cost impact to your organizations. So I wish this was the only news that we're concerned about when it comes to the potential bullish factors, but we do need to look at the underlying commodity that is the natural gas markets. So one thing we pay attention to closely is going to be natural gas exports. So LNG, or liquefied natural gas, has been growing steadily since 2019 and even before that. But in the last 6 years, 6 years here, we've seen it go from about 5 BCF per day up to around 17 BCF per day maximum right now. And it's not showing signs of slowing down or stopping anytime soon. In fact, because international prices are so high following the Russia and Ukraine war, which started in around 2022, this has led to Russia no longer supplying the European Union and the UK with all their natural gas, leading to the United States to step in and creating long-term contracts and desire for future growth of American LNGs. As a result, this growth, although seems significant and maybe not stable for now, is expected to be stable as a result of these geopolitical changes in the international sphere. This current forecast, although this is just showing real exports for day to day, going back for the 5-6 years here, forecasts are placing us an additional 12 to 14 BCF higher than where we stand. And for context, a BCF is a billion cubic feet per day, and a billion cubic feet per day is equivalent to a million decatherms per day, which when we're dealing with your contracts, typically we're looking at them in terms of decatherms. So this is a million times that volume that you're seeing on your contract done every single day for each decatherm there. So it's a very large amount of volume right here going out of the country every single day, and it's not showing signs of stopping. And this demand growth is starting to stretch the market, and it's unfortunately doing a couple things, because it's not just pulling on natural gas at the national space, it's also pulling it from the capacity lines as well. When we think about the delivery of natural gas, where it's coming from, typically we'd see natural gas be pulled from the Marcellus Shale region around Pennsylvania and Ohio, and then flowed northern up into the New York region, or it'd be coming down from the Texas/mid-Atlantic coast and then flowing northern across the coastline up into your territory as well, because you don't have production in New York at all for natural gas. As a result, this has pushed us to see higher costs for the basis piece, just as you're playing tug of war essentially against those pipelines who are now trying to divert it to provide for these LNG facilities, which are situated across the coasts. This is another driving factor, and also kind of taps into one other item that we should touch on, which isn't really explicitly stated here, but does have to deal with supply, which we'll also touch on next. But when we talk about the overall headlines that we've been dealing with, one thing, of course, that we always talk about is going to be those tariff situations, which are will they, won't they kind of thing. Lots of conversations happening around that, and it's a day-by-day situation that's constantly evolving. But when we look at the tariff situation, and if it is to happen or if it isn't to happen, we do import natural gas from Canada into this territory, and we do import power from Canada into this territory. This means that there could be small but direct impacts to power pricing and gas pricing within the New York territory. That does help bolster supply, especially because most of natural gas is not pulled out of the ground in New York. It's permitted in New York. So when we look at supply, we do have to look at it in a national space. And one thing we need to keep in mind as we see this large demand growth is how do we compare with the supply piece as a whole? And all I want to do, just as a reminder for this slide, is do a quick comparison for where we stand difference-wise over the last 5 years. You can see we went from 5 to around 15, 16 BCF per day. So let's just say 16 for argument's sake. A solid 11 BCF per day change over the last 6 years. When we look at supply, we've seen a relatively similar growth pattern, where we've seen natural gas go from around 87 BCF per day up to around 106. So it's a larger outpace actually from the production standpoint than just at LNG. But as a reminder, LNG is just one demand sector. We still have other pieces. For example, if we have it for residential commercial usage, that's going to be used for heating and cooling using natural gas for that purpose. And that's been going up. Even with electrification, just naturally speaking, it's become a larger sector. And that also has to be the same with the use of natural gas for power generation, especially within the New York State region, where electrification has been larger. Ironically, because natural gas is used to create electricity, if we're using more electricity in order to cool and heat buildings across the state, we're using more of those natural gas generation facilities to do so. And this is not an NRG thing. This is just a statewide and nationwide trend that we've been watching. And when we look at this overall change on the production number, it's more or less tracking with how demand has grown. And what I take away from that is that producers aren't really shifting how much they want to create. They're not looking to create an oversupply situation that we saw through the 2010s era. And this has pushed pricing upwards in the short term, and definitely is a bit of a concern if I'm a buyer right now. Further enhancing that exact storyline is the graph on the right-hand side. And now a rig count is not necessarily supply growth or a running rig right away. A rig count more or less is what I'll use to help demonstrate future investment into production from production companies like EQT or Chesapeake Energy, who are providing a lot of the natural gas in the general region. And when these rig counts are counted, what we look for is actual physical growth in demand production 6 to 9 months after they show up on the rig count numbers. So when we look at these numbers, you kind of see that's relatively flat over the last year here. Total, it's been a decrease, but it's flattened off in the last year. And what that shows to me is that suppliers have been what we would say disciplined in their capital expenditure in order when it comes to production numbers for future growth. And this is because although natural gas prices aren't as favorable as they have been, the cost of capital for them to invest in this infrastructure by building new wellheads, investing in labor, the materials and infrastructure to build pipelines to feed into these has gone up. This is partially due to tariffs, not just tariffs. I mean, although it does have an impact, I'd say the primary impacts would be from things like interest rate increase, the costs of capital and the borrowing aspect of cash in order to invest in these sites, along with the fact that if you look at the outlook of natural gas pricing, not very favorable. If the overall plan for natural gas for the next few years is for the price of it to decrease, it would be a bad idea for these folks to be investing right now. And this is a bit of a concern for the long term because all it takes is one hot summer or a very cold winter to completely blow the market back out of the water to the highs that we saw in the mid 2022 range. So when we put supply and demand together, we usually don't have an exact lineup. And you kind of saw that with this last graph to this current one on the left-hand side when you check supply versus demand. And one thing we look at that is, hey, if we have a surplus day over day over day, we end up with a surplus total amount that gets put into what we call storage. And storage is a national number. It's not just local. This is just something we track on the national scale and local scale for that matter. But the national one's what's mattering for our primary contracts. And what we see for this is that current storage numbers are rounding to TCF, 2,000 BCF is what we're looking at right there. And the number we're at is pretty close to the 5-year average, but it is much lower than where we were even just 1 year ago. And so when I look at this chart, kind of says we're sitting on what I would say a bit more of an unstable equilibrium point because supply and demand are relatively equal right now, but we're at a higher demand point with less flexibility on the supply portion. It's overall just a bit more concerning from this perspective. And if we look at how the natural gas cycle typically works, which you can see on the right-hand side, we'd see typically gas prices go up, the industry would create more production numbers, the market would go into an oversupply, build a glut, allowing prices to fall, the market would retract, and then it would just continue that cycle. Well, if we have a situation where producers are saying, hey, we don't really want to produce anymore, and they're using that language on their earnings call saying we are remaining capital disciplined, then that insinuates that we're at a situation where they don't have the room for gas prices to fall right now. They think that the market has thus retracted and are waiting for gas prices to rise before they build more. That's where I am concerned. And that's where, when I look at prices for natural gas, I look at that as an opportunity to make sure that your companies are prepared for the future. This is a market graph showing the average prices for different calendar years in the forward strips. A strip is just an average price for each of the calendar months. A 12-month strip thus would be the average price of, in this chart, it would be May through April of next year. And then you can see January through December of 2026, 27, 28, 29, and 30 respectively. And what you need to look at, what I think is most interesting, is going to be the fact that you see the prices go down over time. We call that a backwardated market. This is not something that happens that commonly. In fact, if you look at every time prior to 2023, it had recent history going back towards COVID era, at least, we see what we call a contango market, meaning that the prices get progressively more expensive as you go further and further out in contracts, at least if you're negating the 12-month strip, which also saw a lot more volatility due to the fact that it was the Ukraine and Russian war that just kicked off. So when I look at this chart, the thing that screams out to me again is the opportunity to ensure that you get that longer term contract settled before more risk is involved. We are fundamentally in a different shaped market, different supply demand factors, different load growth expectations, just from everything from LNG, from AI data center growth, from electrification demanding more natural gas for generation, causing us to see a large expectation of growth when you look at those fundamentals, contrary to what these for what these prices are demonstrating. And I have many customers who've already started looking at those long-term contracts, or at least positioning themselves in a way with sorts of contracts that guarantee transportation and enable them to transact on layers so that they could take advantage if they feel the price is right for them at the time when it's right for them. And we could talk more specifically with your individual organizations, with you specifically, if you think this might be the right product for you. But this is a more nuanced conversation to be had because everybody has their own risk appetites, their own policies for how they manage contracts, and how they want to do business differs as well. And us here at NRG and the folks like Harold and Johnny over at Council of Industry, they've been fantastic in being advocates for your companies and trying to say, hey, we are here to make sure that you are prepared. And this is one way that we at NRG are here to help as well. So that was all natural gas. And one thing I said earlier still stands out that I think is important when I move to this next slide, which is going to be natural gas is following very similar fundamental drivers and pushing those forward into the power markets because power is primarily devised in the New York region by natural gas. Developed, excuse me. So when we have generation that's being built up primarily of natural gas, where then is the power pricing looking like? What do we pay attention to? Well, differently than natural gas, there's a few more components. So I want to bring this quick chart up so we could just acknowledge what's in here. But natural gas builds much more into the energy market, the energy portion of the total energy bill. Your electricity bill includes several different items. We have here demonstrated the energy piece. You have capacity, TOTS, ancillaries, and CES is the main component budget, like pieces that I put as a cost component breakdown. And when I look at energy, if I'm looking at that 65% compared to the remaining pieces, that's what you can manage. You also can manage a bit of capacity, but everything else more or less is pretty much set by state and utility factors that we don't have a lot of say over and you don't have a lot of say over either. So when I look at energy and I look at capacity, I pay attention to those because, hey, that's a large portion of your bill. And I don't want to be picking up pennies and worried about the small parts of the contract when these larger pieces are out there causing you to potentially lose dollars if you're not paying attention. So energy is expensive as part of your electricity bill. And then we know that electricity is driven by natural gas. So where is electricity? Well, it depends on your territory. Unlike natural gas, territory is very specific for how much your power is going to cost. It's going to be very locational dependent. So how do we manage it? Well, one of those ways we can help you manage it is by paying attention to those specific markets. Now, I did pull one that's going to be for the city. I chose an in-city location just because I think it's more demonstrative of the conical nature that is New York State when you look at the power markets. We usually think of it as you have New York rest of the state, you get the lower Hudson Valley, and then you get the New York City region. And when we look at how prices move, the city drives a lot of changes, and then they kind of spread out like that. And so there's a kind of concentric focus yet again on how the state functions. And we always use this as kind of one of our first markers. I should note that typically speaking, this also means that they deal with higher prices than you would be receiving if you're not based within city limits or within the Zone J territory, as we call it. But if you are around the Albany area, there can be also high prices. That's capital region. So they do have different markets. These are just generic prices for this one specific territory. But I thought it's a good demonstration about how New York is moving as a whole anyway. And this is just our little spaghetti chart showing similarly calendar strips going from 26 through 2030. And for simplicity, just take a look at the light blue line versus the gray line. Light blue being 2026 for next year, gray being for 2030, a few years down the road. And you could see that throughout history, gray for the longer term used to be more expensive than the blue. And then all of a sudden, after this winter, it flipped. Everything else is in a very tight band, but demonstrates yet again that backwardation factor that we've been factoring in on the natural gas side. And yet another item that we should be considering as opportunity for us to take a look at for the power side. And it also demonstrates something else. We've already talked several times now about the fact that natural gas and power are heavily correlated. This demonstrates the fact that, hey, if you do have a natural gas bill, if you do have a power bill, if we're only working with you on one of them, you should consider managing them both similarly because they do follow similar patterns. And operating as such will help simplify your business expenditures, business management, and contract management. So we can help with that process as well. When we do look at this, it is a general shift downwards. That's another thing I want to keep a note. Since 2024, mid-May of 2024, prices have moved down. And we're in a situation right now where that is fairly optimal. But the main crazy thing to me that points out the most is the fact that it's not necessarily just the short term, because usually that's where you see the most volatility. It's actually in the outer years. And so this is something that you might not have considered in the past because it's so far out historically if you had done contracting last year, the years before. But the remainder of 2025 and most of 2026 has seen a lot less movement than if you're the 2027 years and onwards. So this is another chart showing a similar thing, just showing each individual month, the trade ranges, and then how much has moved since last year. And these are prices I pulled from a month ago, and prices have moved since then, of course, but they demonstrate very clearly the fact that looking at longer term prices, we're seeing opportunity that didn't exist previously and pushing us, especially in the winter times, some of the lowest prices available. So I just want to say, be very cautious with the future of these markets. It's ever changing. We're here to help you. And in fact, there are even programs that we can help get you enrolled in if you have the ability to reduce your energy that can actually give you a paycheck. For example, I don't have slides on this right now, but they're called our demand response or curtailment incentive programs. And these sorts of programs are ways that you can find ways to increase revenue by getting a new source of revenue, by getting paid for reducing electricity and helping free up some of the capacity concerns that New York ISO would have just during high peak times. So a lot of our larger entities have looked at programs like those because when we see how businesses have been stressed within these territories, they're scrambling and looking for any ways to make sure that their budgets are doing the best they can be in these constantly frustrating times. So lots to unpack. Of course, I could talk on this forever, and I don't want to bore any of you. So I'm going to keep it short and sweet at what we have right here. I have plenty more information I'd love to share with you and more specifically with your organizations and see how this kind of new changing market could apply to your business. And if you do have those questions, I urge you to please reach out. I have this last slide here with some of my contact information that you've probably seen me floating around at other Council of Industry events, but I urge you to reach out after this. And until then, I think, Harold, actually, if you have any questions you'd like to ask, I'd be happy to answer some right now, and then we can follow up after with anybody who reaches out.
Sure. Thank you very much, Dylan. That was great. I really appreciate that. Lots of information there. A couple of questions. You mentioned electrification, and you kind of connected that to reduced gas usage or gas being used to generate power. Can you talk a little about the impact on capacity as well as just the supply charge?
Yeah, that goes into more of the capacity portion, which has been a large concern over the last 5-10 years here, because that's been a large portion of the increases. And I'll go back another few slides just to show this piece again. But in the top right, we're talking a little bit about the definition of capacity. And when we think about capacity, it is how the market is set up in order to ensure that there's always enough electricity when demand is at its highest. This is the charge that is assumed in order to make sure that there aren't blackouts in New York State based on demand, at least. There could, of course, be things like power outages because of a tree falling on the power line, but this is to make sure that there's enough generation available. And electrification has actually been stressing that piece. And in fact, in 2030 to 2031, we're expecting to see potential flip from a demand perspective, from a high demand during the summer season to a higher demand in the winter season because electrification is being used for heating purposes. New York State can get very cold. So When we talk about electrification, it's not just for like ranges and stuff. This can often be for those heating entities, which when we talk about capacity is going to be stressing that amount of demand even further in the future because you're going to use more electricity than the grid was previously set up for because there's a lot more power usage from heating than there is just from using natural gas directly. Just laws of thermodynamics. If I go burn natural gas in point A, you're getting that energy right off the bat. You'll get some light, of course, and losses. But if I instead go burn it 300 miles away and transmit it via direct current lines, 300 miles, you're going to have energy losses along the way. And then you're going to go push it into a heating element, which is going to have losses. And therefore, you're using more natural gas. Capacity is going to be higher because you're using more energy during those time periods. And then on top of that, the generation stack within the New York State region has been stressed, it's aging, and they're also looking to reduce some of the peaking plants and increase renewables. Overall, it's just a very stressed market as it comes to capacity, and it's not necessarily showing any signs of stopping anytime soon.
I guess that's my follow-up question.
That capacity is a market, right? I mean, you have it down as 8% there, but it changes, correct?
Yeah. Yeah, capacity actually, I should have taken a look at this. Capacity is actually sitting at 11% in this one.
I
This
read
is
it
just an
wrong.
average one. So this can vary greatly depending on who the customer is. I should note that capacity can make up a larger portion for some folks, especially depending on which territory you're in. If you're closer to city, for example, that might be higher cost than if you're further away. But the capacity charges that we've been seeing have been going generally up over the last 5 years because of these stressors on the markets. It's been definitely something we can manage just by helping say, hey, when the grid is paying attention to how they charge you for capacity, it's based on your usage on the highest usage day of the whole July and August timeframes. And so they say whatever the highest usage day is within in New York ISO, we're going to take your meter and say you're using this much at that time, and that proportional amount will help us see how much of a weighted average that you're going to be applied for pay for all the generators within the territory. And if you're able to reduce your usage during that measurement time period, you can get your capacity down to nearly zero and not have to pay capacity whatsoever. We can help offer software and alerts to help you with that sort of management alongside the demand response and curtailment incentive program. So you could get, actually, it's kind of triple dipping. You get reduced energy bill during that month. You get reduced capacity payment for the year after if you participate during those times as well. And you also get a paycheck bi-yearly, twice a year, for helping reserve capacity for the grid rather than for your own location.
I think we should definitely revisit that in another webinar.
Absolutely.
That sounds great. And then just, finally, you talked about that backwardation, or is that the right word?
Yes. Yes.
So from a strategy standpoint, a lot of our members like to fix their contract, know what they're going to have, and have that budget certainty. But is there an advantage to maybe floating? And that's one of the products that you offer as well in that scenario. Would that be something to think about in that regard?
That is a great question as well. So what you're talking about, Harold, is that there are multiple different type of products which we referenced. And one thing you can do is guarantee transportation, whether it be for natural gas or for power outers. And what we'll do is we can allow you to purchase the actual physical supply, whether it be electricity or natural gas, separately mid-contract throughout the contract for varying amounts of that volume that you have on contract for transportation. And so what this essentially turns your gas and power buying into is a dollar cost averaging exercise. It means that you're never going to hit the top of the market because you'll have multiple lines in the sand anchoring you down. And unfortunately, it does mean you won't ever be the exact bottom. But when we are buying natural gas and power, this is a clear, necessary commodity for all of your businesses to be able to function. And so playing defense on this is key, and being able to be risk averse helps spread that risk throughout the market, not necessarily saying, hey, I'm going to buy potentially now and stick with it only. Could it go further down? If this winter says it's going to be cooler and as actual than it is really forecasted, we could be in a better situation, allowing for a better pricing environment. That could be a great reason to go partially floating for now, but alternatively, it could be a lot hotter. And so taking a layer out, being prepared partially now, and then being ready to act later if market situations change allows your company more flexibility and maneuverability than more nuanced and hands-on. We're here to be able to help be your partners in that discussion and managing your natural gas and power portfolios.
That sounds like a perfect way to end. Appreciate that very much. Maybe you can put that contact slide up one more time there. We will certainly share it as well.
Thank you, Dylan. Thank you, Harold. We are fortunate to have Dylan as a partner. He is proactive in helping our members minimize energy risk and maximize benefits. Thank you so much for taking the time today. We really appreciate it, and we hope to see you soon.
Thank you very much. Thank you for your time.
Thank you for watching Inside Exchange, Topics for Manufacturers. We hope you found today's episode valuable. To learn more about the Council of Industry and explore additional resources, visit us at councilofindustry.org.